Welcome back, students. Yes, very good afternoon. A happy afternoon to all. Hardik, Riddhi, Tambeshwari, Pranav, Niru, everyone, Bhumika. So, we are in a very interesting chapter. We have as good as completed it, but we'll take today's session to go through the module and whatever doubts you have in the module, plus some more minute detailings of certain provisions that we find in the module. So let us start with the module detailings. So as you can see, firstly, our module gives us the format. Now, what does the module says? Pro forma for computing the income, and they are giving this format under the default regime. So first is the default regime. Now, basically, please remember, the special deductions are what are not allowed in the default regime. The regular deductions are allowed. Now, as you all know, our approach, our method of computing the income is the reconciliation method. What is the reconciliation method? You start with the net profit as per accounts, that is P&L. And in that, we have to adjust either by adding or subtracting those amounts which are difference between the accounting P&L and let us say the PGBP P&L. We never prepare a P&L in PGBP, but just for visualization, let us assume that you are also preparing a P&L as per PGBP, taking on the credit side incomes as per PGBP, which is 28 and 41, and in cases valuation as per 43 CA, and on the debit side taking expenses as per 30 to 37 with restrictions from 40 to 43D. Now, when you have both P&Ls, one prepared as per accounts, one prepared as per PGBP, now you compare both to identify, is there a scope for any type of difference between any figure or any entry in the accounting P&L and in the PGBP P&L. And wherever you find a difference, that is adjusted. So let us now, since we have understood the whole format, or rather the whole provisions, let us now understand the format. So you start with net profit as per P&L. In that you will add expenses. But what is very important, students, to notice, which are already debited to P&L. Because if some expense is not debited to P&L and it is not allowed in PGBP, so we will make no adjustment because both set of P&L have no effect of that. I repeat, it is not debited in P&L. At the same time, it is not allowed in PGBP. We'll do nothing. But here, where it is debited to P&L and it is not allowed in PGBP, that is where we have to adjust because it is not debited. Sorry, it is debited to P&L, so profit is reduced of P&L. But PGBP does not allow it, so PGBP profit is higher, and that is where you have to add. Now, first is depreciation. Now, actually, what we do, because we are accounting people, we have done this in past, that we take the difference of the depreciation and we adjust the net. The other approach is whatever depreciation is debited to P&L, that is as per account, you first entirely add the entire amount, and then in less, you subtract the entire amount of depreciation, which is as per account income tax provisions, that is section 32 read with rule 5. So one approach is what we have done, take the net. Another approach is what is shown over here. You can take both figures gross, accounting depreciation add, income tax depreciation less. Fine. Then the second item which is disallowed is direct tax, as we have studied, revised multiple times, that under section 40 clause A, any type of direct tax paid will be disallowed. So if it is already debited to P&L, you have to add that. Then we come to those expenses where the payment is made to resident and it is made in India. So I call this as domestic expense. Now, in respect of domestic expenses, you have to disallow under 40 clause A, various subclauses, if either you have not deducted the TDS. Now, by when you have to deduct the TDS, you have to deduct the TDS anytime during the previous year. so on which TDS has not been deducted, or after deduction has not been deposited before the due date of filing returns, which is given under 139(1). Now, since this is a domestic expense, if any of this default occurs, what will be disallowed is 30% of the expense. So for domestic, it is 30%, and for foreign expenses, it is 100%. That will come after this. Now, the other disallowances under section 40A, that is capital A, subsection 2. When this disallowance triggers whenever you have done some type of expenditure with those persons who are your related persons or who are your business associates. And most importantly, the payment that you have made to them is exceeding the FMV. Now, what has to be added over here is only the amount to the extent your expenses are exceeding the FMV, that is, they are unreasonable. So if your expenses are up to FMV or your expenses are lesser than FMV, nothing to be adjusted. Only when it is exceeding FMV, that is where you are showing extra expense in P&L to reduce the profit and the tax. That is not allowed. You have to show up to FMV. So excess will be added. Then comes a 40A3 restriction. What is this 40A3 restriction? Again, you have made payment of any expenditure and in a day, it exceeds rupees 10,000. Now, this should be made compulsorily by way of account pay, check, draft, or any approved electronic medium. If you haven't done that, then the entire expenditure which is paid is disallowed. Here, there are two exceptions. One, for transport expenses, it is 35,000, this limit. And two, for certain expenses mentioned in Rule 6DD, this restriction does not apply. So those expenses, even if you pay in cash or by bearer check, it will be fully allowed. Then certain sums payable by the assessee which have been paid during the PY in which the liability was incurred on or before the due date of filing return in respect of that PY, that is 43B, that is simply certain expenses will be allowed only if they are paid till when? Till the due date of filing returns. However, in this same section 43B, there is one different provision that is for payment to MSM. This will be disallowed if the payment is beyond the time limit specified in section 15 of the MSME Act. Then personal expenses are disallowed, capital expenses are disallowed, repairs of capital nature, amortization of preliminary. Now, if you recall the preliminary section, if you remember, we allow 1/5. Now, if let us say entire preliminary is debited, 1/5 is allowed, the excess is the 4/5 part that you will add back. Similarly, family planning. When it is not allowed, nothing is allowed if the person is not a company. Because if you remember, when we discussed family planning, there was a rider that it will be allowed only if you are a company. So if you're a person other than a company, entire family planning, whether revenue, capital, nothing is allowed, not 1/5, nothing. Next, if you have paid any fine penalty, and what is the nature of this fine penalty? It is in such a manner that it is not for any type of offense, etc., then it should be allowed. However, where it is for any offense or any illegal act, it will be disallowed. So both points are given over here. Firstly, what is added is fine, which is majorly in the nature of an offense. However, penalty in the nature of damage for delay in completion, etc., which is not in the nature of offense, will be allowed. So breach of contract penalty allowed. Breach of law penalty leading to offense or a crime not allowed. Next, all expenses related to income which are not taxable under this head. This we did in the first step itself. We remove the effects of all those incomes and expenses which belong to other heads. And any sum paid by the assessee as employer by way of contribution to pension fund under section 80 CCD exceeding 14% of salary. This is one special point given in section 36 subsection 1. So as an employer, you have to contribute to employees' funds. For all other funds, whatever you contribute is allowed as deduction. However, when you are contributing to the pension fund of the employee, the limit of deduction that you will get is up to 14%. 14% of what? 14% of the salary. Now, what has to be subtracted? Expenses which are allowed as deduction, where in PGBP, but it is not debited to P&L. So there are n number of examples where the P&L is not debiting it, but PGBP allows. First, depreciation as we discussed. Then, interestingly, this 30% which was disallowed above, now this 30% will be allowed in that future year in which you go and deposit the TDS. So whenever you comply with the conditions of 40 clause A, it will be allowed as deduction in that year. So the same amount which was disallowed 2 years back will get allowed in the current year because you have paid the amount in the current year. That is, you have deposited the TDS. Next, similarly, amounts which were disallowed under 43B because you did not pay them up to the due date of filing returns, the amount will now be allowed in the year in which you make the payment of those expenses. That is to satisfy 43B. Again, what is to be deducted is incomes. Now we come on the credit side. Incomes which are already credited to P&L, that is in P&L, you are showing it as income. And in that particular case, it is not taxable under the head PGP. It may be taxable under any other head, maybe HP, maybe other sources, maybe CG, whatever, but it is not taxable under PGP, and we are exclusively finding out PGP. So that is what you will also subtract because that has been included in the P&L credit side, leading to increase in your business profit, P&L profits. So to reduce that, you'll subtract it. Now here they have made a list of all those incomes which are covered under different heads like dividend, agriculture, interest, all these are other sources income. Then profit on sale of any capital asset, this is CG head income. Rent from HP, which is HP head income. Winnings, gift, all these are other sources income. Then income tax refund. Now this income tax refund, let us say you paid tax in some earlier period. Now that was found to be excess, so it is refunded back. It will not be considered as income. Why? Because at the time of payment, we have not allowed deduction also. So while you are paying expenses, it is not allowed as deduction. So while recovery or refund, it will not be taxable. Similarly, this interest, this refund may come along with interest. Why? Because the refund was received late. So they are also paying interest. The interest is taxable, but it is going to other sources. So here in PGP, it is less. Then comes some other expenses. Sorry, not expenses, incomes chargeable under the head PGBP. So these are taxable under PGP, but somehow they have not been included in your P&L. So now you are going to add it to find out the final PGP figure. Now, salary remuneration interest received by a partner from the firm to the extent the same is deductible in the hands of the firm. Now, this is from the perspective of partner. When we read 40 clause B, it is from the perspective of the firm as to when and how much it will be allowed deduction. Now, once the firm is allowed deduction of interest remuneration, the same interest remuneration becomes income of the partner under the head PGBP. So, if by chance, while preparing my P&L, it is not included in the credit side, so while computing PGP income, we will increase our profit. Similarly, bad debts recovered and recovery of any other business liability both have the same condition that earlier it should have been allowed as deduction. Correct? Yes, good afternoon, Sani. Kasak is saying 100% would be allowed. Allowed? Won't be allowed. Correct. You're right, Beda. So if it is a foreign payment, the entire amount of 100% is disallowed. Why they may have not included over here? The reason which I could foresee is because at your inter-level, generally international transactions generally are not asked or not covered. Hence, they may have ignored. But anyways, it is not a very difficult point. So you can always remember that. Now, you have computed PGBP income as per the new tax regime, which is the default regime. Now you want to find out PGBP income under the old regime, which is now become the optional tax regime. In such a case, what you can do is you can start with the PGP income as per the new regime. So that is what we calculated above. So you start with that profit or that PGP income, and from that subtract those special expenses which are allowed in old regime but which are not allowed in the new regime. What are they? First is your additional depreciation. New regime does not allow you additional depreciation. Similarly, balance additional depreciation, where in the first year you are allowed only 10%. So balance is allowed in the next year. So in simple case, what they are asking you to subtract is only one item, that is additional depreciation, because new regime does not allow this. Okay. Now you have the in-house scientific research deduction. Here, whatever is written, one simple rule. Whenever we talk about scientific research, whether it is old scheme, new scheme, it is allowed as deduction if the scientific research is in-house related to your business. But if the scientific research payment is to an outsider, I repeat, scientific research payment is to an outsider, outside approved association, college, university, etc., etc. In that case, it is allowed as deduction under the old regime, but it is not allowed as deduction under the new regime. So that is what you have to keep in mind. So whenever you are making payment to outsider, here there is a difference between old regime and new regime. See, allowability of deduction under new regime not allowable, under old regime allowable. So only for payment to outsiders, not for in-house. In-house is allowed as deduction in both cases, whether old regime, new regime. But when you are making payment to some person who is outsider, who is going to do research, it may not be related to your business, still we are allowing you deduction. So this is restricted only under the old scheme. Now, coming to some theory part, what is business? What is profession? Now, income tax has a very simplified definition. You come to GST, business has a very lengthy and a very comprehensive definition. For the timing, income tax says what? The term business is defined under 213 to include, what are the things included? Trade, commerce, manufacture, or any adventure or concern in the nature of trade, commerce, manufacture. So where you are doing any of these three activities, trading or commercial, like providing service or manufacture, or you are doing any such activity which is in the nature of trade, commerce, but which is in the nature of an adventure. Now, what is an adventure? Adventure is something which you are doing only for one time. You may not repeat it next time. So adventure is when you go to a place unknown to you. That is what we call as adventure. If you repeatedly go to the same place, it becomes a picnic. So adventure in the nature of trade, commerce means where you have started that business, but there is no guarantee, no surety that you will continue. Similarly, the term profession has not been defined in the Act. It means an occupation requiring some degree of learning. Now, it is not defined, but it is explained as where your work requires some degree of learning. They are not saying formal education or they are not saying qualification. They say you require some degree of learning. That is only after studying, learning, training, you can do something. That is where you are said to be a professional. Now, the term profession includes vocation. What is vocation? Vocation is where you are engaged in a profession which is a lifestyle also. So your lifestyle, when linked with profession, that is whatever is your profession defines your living habits, lifestyle, that profession is called as vocation. Example, people who are doing puja part, that is Panditji, that they, if you observe, even their dressing, their daily routine matches what work they are doing. But when we as professionals, we are also doing profession, but our work is not called as vocation because my personal life, my personal habits may be different. Different means there is no linkage between that. So a CA should live in a particular manner, should always dress in a particular manner. There is no such thing. So that is why CA is a profession, but people doing puja, part, yajna, all types of these religious activities, they are said to be in vocation. Now, some clarification they have given about business and profits. Yes, Hardik, please. We can take doubts also, not a problem. Go ahead. So Hardik has a doubt in section 40 clause B, which is relating to partnership form.
Yes, good afternoon, sir.
Good afternoon, beta. Tell me.
Sir, in the 40 clause B, sir, usually there is like interest, maximum interest allowed to a partner is 12%, correct, sir?
Correct.
Sir, so sir, the deduction, sir, if the company is paying say a interest of 15%,
Okay.
and the profit is given like before the deduction of this interest, then
Okay.
sir, we
Okay.
will, deduct only 12% interest, no, from.
Yes, you will deduct 12%, but then you'll have to first check whether the partnership deed has allowed for this payment.
Yes, sir, partnership deed has allowed it.
Then you will deduct 12%, beta.
Only 12%, not 15%.
You may have agreed 15, but we will allow maximum 12.
Okay, sir. And sir, sir, if in an example it is given that the salary is not recorded, and in
Hmm.
second example the salary is omitted,
Hmm.
then sir, salary not recorded means undisclosed income, and salary omitted can be taken as a deemed income.
See, beta, here, if I'm not wrong, our module has given this as an alternate B, right? Firstly, what is the adjustment?
Sir,
You
salary,
incurred the expense of salary. That
yes,
is
sir.
what you paid salary. But for some reason, because of what we call in accounts as error of omission, it
Yes, sir.
was omitted to be recorded in accounts. And it happens. One check payment of salary was not recorded in accounts. Possible, not a problem, right?
Yes, sir.
Now, when an expenditure is not recorded in P&L, but the expenditure is has happened, it has been incurred. So we apply the four conditions. Is it related to business? Yes. Is it current year revenue? Not an offense. All conditions satisfied. So you are eligible to take deduction under PGBP. That is done.
Okay, sir.
However, when you go to other sources chapter, in
Yes, sir.
other sources, in section 68, 69, they have listed out four scenarios
Yes, sir.
where if one of those things have happened, they will deem that particular amount to be your undisclosed income. Now, one of that item, if I'm not wrong with the section number, it is under 69C, if I'm not wrong. 69C says that if there is any expenditure
Yes, sir.
which you cannot justify, the word is which you are not able to justify or what you are not able to prove.
Yes,
This
sir.
is my correct expenditure, then that expenditure will be treated as your undisclosed income. Fine.
Okay, sir. But
Now,
sir,
yeah. So the point is, beta, the basic point is, I remember there is such a question in our module, but that answer that you are saying that it is also treated as income is only an alternative treatment given in the module. So they have given two treatments. One, that is you only consider it as a deduction in PGBP.
yes, sir.
Second, you consider it as a deduction, plus you also consider it as income on account of undisclosed. Correct?
Yes, sir.
Yes. So that is the reason because that is what is covered in section 68 and 69 provisions.
So, sir, we have to write like both the provisions, like alternatives. We have to give it in
See,
exam.
beta, remember one thing. When something is alternative, you can also remember it is optional.
Okay, sir.
So it is not compulsory that you write first. Second thing, please understand better, you all are doing this for the first time in your life. PGBP you all are studying. In fact, the
Yes, sir.
entire income tax law you are studying. So even if this point has not come to your mind, it is okay. Because even if you have given me one treatment, we are giving you full marks.
Okay, sir.
That is given because the law, because the module wanted you to know, okay, these are the various other possibilities. Means this is also how the law can be interpreted. That is why they have given. But it is not compulsory for you to give the other option also.
Okay, sir.
Yes.
And sir, in section 10(2)(a) for the profits which we receive from a partnership firm, sir, it
One
is
second. 10 to A. Yes. So profits that you are
10 to
receiving
capital A.
from partnership firm as a partner.
Yes,
Since the partnership has already paid the tax on that net profit, in the hands of partner, the net profit is exempt.
sir.
Understand the logic? See, partnership gives you three payments. You are
Any proof-related question on this, sir? Because I'm not able to find it on a like module.
no, so why you want a question? This is what is the provision. So where the question will be applicable when you are solving a PGBP sum, they may give you in the adjustment that during the year, this particular person who's working you are doing has also received these three payments from his partnership firm. One is interest, one is this, one is this. Now for interest and remuneration, what you have to check is whatever you have received, whether the same amount is allowed as deduction to firm. If the
Yes,
same amount is allowed, the entire amount is income. If the firm is allowed lesser deduction, like in your previous example, interest paid by the firm was 15, that is you are receiving 15, but income tax allows 12. If that is the case, so firm is allowed 12, so you are taxable 12.
and remaining 3% will be taxable in the hands of partner only.
Nahi na beta, that is why I said na, you means the partner na. You
Sir,
are
if
taxed
the
only 12 na.
no, sir, if the partnership deed is allowed 15%, then they will give 15%. They are tax exempting for 12%. They are paying tax for 12%, but the
Who
remaining
they, who
3%,
they, who they,
sir, the company.
not company. Beta, we are talking about a firm and partners.
So partner will pay for 12%.
Yes, because for firm, 12% is expense. So for partner, 12% is income. See,
Okay,
remember the golden rule. One man's expense is other man's income.
yes,
So
sir.
if firm is allowed deduction for 12%, you will be taxed only for the same amount.
Okay, sir. So
So for that
3%.
15%, the extra 3%, neither the firm gets deduction, so neither it is taxable to you.
Okay, sir. Okay, sir. Got it. Thank you, sir.
Correct?
Yes, sir. Yes, sir.
There was somebody else who had raised hand. Is the doubt still pending? Who else had raised hand? Yes. Anybody else having a doubt? No, my hand is raised that I can see on the screen, but there was somebody because the video box of that person had opened for a minute when I was discussing the doubt. See, my hand gets raised because I think there is some motion sensor. So when I'm explaining like this, when I put my hand like this, the Zoom senses the motion and it is showing the hand raise. So in fact, you all can also do like this and your hand raise will be appearing. No, sorry, your may not appear because you all have kept your video off. Okay, so if there are no further questions with anyone, let me proceed. So now here they have given some basic features, characteristics about business and profits. Now, this is, if you remember, I discussed when I was explaining 43B section. What is this method of accounting? So this section 145 is the section dealing with method of accounting and what does income tax law says. While computing income from two heads, one is PGBP and one is other sources. The law has kept the option to you that how you want to prepare your books. If you are preparing your books by cash basis, we will compute your PGP income by cash. If you are preparing your books by mercantile basis, we will compute your PGBP income by mercantile basis. That is what this 145 says. Then you have 145B. What does 145B does? 145B creates an exception to the above rule. So the main rule is you have a choice which method of accounting you want to follow. Whatever you follow, we will follow the same method of accounting while computing your PGBP and other sources. Only two incomes, not all. Remember this. So only for two incomes, this section applies. Now, as per this, you have a choice. You can take any of the methods. However, the exceptions are in 145B. 145B says that first, where you are receiving interest on compensation, so your property has been compulsorily acquired by the government, and the government has to pay you compensation, which is delayed. So the government also pays interest. The compensation is a capital receipt. It will go to your capital head working, and the interest will go to other sources. Here, This is another sources item, the interest, but it will be taxed, or the income would be computed only on receipt basis. So that is why it is exception to the main section of 145. So here it is not giving you option. It is saying only one method, that is it will be taxed only on receipt basis. Same thing, they have given the same rule for some other income, that is where you are given subsidy, grant, assistance, drawback, etc. by government. So where government is giving you any of these benefits, then again the income or these benefits are added to your PGBP, but it will be taxed in the year again in which it is actually received. So many times you apply for a subsidy, it may take 2 or 3 years. That is not deciding factor. So it will be taxed in the year in which you actually receive the subsidy. So these are the two exceptions to the rule that you have option. Then, if you remember, we had discussed this, that like how you have accounting standard for computing or for determining various accounting effects, similarly, you have income tax standards as well, which are called as ICDS. If you observe, you'll find that many of these standards are very much similar to what you have in income tax or in accounting standards. So they match each other. These are called as ICDS, income computation and disclosure standards. Then it is section 28. Section 28 gives you a list of those incomes which would fall under the head PGBP, that is tax under this head. Now, 28 is the first section of this head. So 28 is also called as the charging section of PGBP head. So if you remember this, I had mentioned at in the initial lectures that every head's first income is its charging section, because that section gives you the details of what incomes would fall under that particular head. Hence, the first section of every head is called as the charging section. Now, under the income tax PGBP head, it is section 28. It gives you list of incomes which will fall under this head. So first is, it says income arising from business or profession. So first category which it covers is business incomes, that is income arising from exercise of any business or profession. Now there is an amendment from this year by which they say that you are engaged in the business of giving property on land. So letting out is your business, but if it is letting out of residential houses, if this is your business, it will no more be covered under PGBP. It would go to HP. But if your business is letting out of commercial properties, it is still covered under PGP because of the first clause, because what is covered under this head is income arising from business or profession. Second, what is covered is, as you can see, the second item that is covered in this particular head or in this particular section is various types of compensations. Now, what are these compensations? These compensations are compensation linked to business. Now, how they are linked to business? See, a person by whatever name called managing the whole or substantially the whole of affairs of Indian company, etc., etc., at or in connection with termination of the management. So what is this? The point is simple. Why are you receiving this compensation? Because you have foregone your rights of management of any Indian or foreign company. So in short, you are foregoing your right to do that particular activity, and as a compensation, you are getting this. Similarly, point B, same, you are having the agency of any particular brand in India. Again, you decided to terminate that or you decided to amend that. That is where you are given a compensation. If then that particular compensation will be treated as your PGBP income, because doing this is your business, correct? Similarly, where you have to vest your rights in any business with the government, like which is called as nationalization. So, like how in 1990s, India went for nationalization of banks, 1990s or I think 80s somewhere, not 90s, 90s is wrong. It would be earlier than that because it was during the Indira Gandhi regime that India went for nationalization, whereby there were private banks before that, but the entire management of the banks was shifted to government. So when any such thing happens, it is vesting in the government of your controlling power of any business. So when you vest in the controlling power of any business, again, it becomes your PGBP income, whatever compensation you will get for that, right? Now, what else is covered? Again, compensation is for what? In connection with termination, modification of the terms and conditions of any contract. Fine. So in all these cases, okay, I have received the reply by Vaikuntha Vasu. Wow, super name. So Vaikuntha Vasu says India went for nationalization of banks in 1975. Okay, thank you, Vaikuntha Vasu. Then the next category of income that is covered under the head PGBP is where what has happened? You are providing some services to your members, like our institute. Now, we all are members of our institute. Now, when institute is providing us any services, and for that the institute is charging some fee, some subscription amount, some annual amount, that is what is taxed under this head. So our institute is a professional body. So where any trade or professional or similar association is performing any specific services for its members, and for that purpose it is charging any type of fees. Then these are all export related benefits. So when you're doing business, your business has exports. So whenever you make exports, you get different types of benefits. All these benefits that you receive would be taxed under the head PGBP. This point number 7 is, we call it as non-compete fees. What is non-compete fees? As you can see the heading, sum is received in cash or kind under an agreement for not carrying out any activity in relation to business. So this is called as non-compete fees. So wherever you receive a non-compete fees, it would again be part of PGBP. Next, any amount that you received under a Cayman insurance policy. Next, if you convert your FI stock in trade into capital asset, in that case, what you get is your PGBP income. And last, if you remember this, your business is 35AD, correct? Now, in this 35AD business, if you remember, if the asset is sold, then on sale of the asset, whatever you receive, that will be considered as your 35AD business income. So that is all about the 35AD and this particular receipt. Now, this is an interesting concept. Though this concept do not have much application, much use under the PGBP head as such, this is more useful when you do the set-off chapter. But what is this particular concept? Let us understand. The name is speculation business, or you can also call it as speculative business. Now, many times when we use this word speculation or speculative, the first thing that comes to your mind is share market. And we believe that whatever we are doing in stock market or share market, everything is speculative. Answer is no. I repeat, the answer is no. Not everything is a speculative business. Then what is a speculative business? For this, they have explained what is the definition of speculative business. The definition of speculative business says that wherever you are entering into a contract and the contract is for purchase sale. If it is a regular contract of purchase sale, no doubt, yes. Now the point is, where it is a regular contract of purchase and sale of any stock or purchase and sale of any type of commodity. Most important, when this particular purchase sale will be regarded as a speculative transaction, when you are completing your transaction, which is said that it is ultimately settled. So your transaction is completed or settled, but otherwise than by way of actual delivery. So you are not giving any actual delivery. Now somebody will ask me, sir, then what is this? What is the real life example? The real life example is intraday trading. Now, within stock market, you have different sections or different types of markets. One is the regular stock market, the real stock market, where we actually buy and sell our shares. That is not speculation, even though you do it regularly, even though it involves a lot of speculation, still it is not speculative business. But within stock market only, there is a segment called as derivatives. In that segment, you do not purchase the shares in real. You only deal with the prices of the share. Like if I get a news that this particular, now this is what Hindenburg does. Yeah, I don't know whether how many of y'all have heard this. So Hindenburg is a short seller. Actually, it is also, there is a lot of controversy whether it is legal, illegal. We'll not get into that. So what Hindenburg does is it invests its money by selling the shares of those companies where it has some internal report or internal information that the prices of that company will fall. So this is what is called as short selling, selling before you have purchased. So you sell those shares first when obviously the price is high today, and then in a week, in a day or two, the prices fall down like what happened yesterday of Adani. Now, in this particular case, you purchase those shares today after the price has fallen. Automatically, there is a profit. But now it is interesting to note, how can you sell something what you don't have? This is where a derivative section of the stock market comes into play, which is only book entry. As you can see, the highlighted portion, your accounts are settled, your transaction is closed, but without actual delivery. Why? Because you do not hold it in physical manner. So I simply pass an entry. I go to the derivative section. I open my account over there. And then I say, okay, today sell 1,000 Adani shares. Today's price is, let us say, 2,200. Now the certain report comes, some action happens, and the price falls to 1,800. Now I say, okay, now you settle this transaction. You close this transaction. How? By buying. So you close this transaction by buying those shares. Now the shares are first sold at 2,200. Now they are bought for 1,800. By this book entry, book adjustment, I will earn a decent amount of profit. So this is where this speculative transaction comes, where your purchase sale transaction is actually settled, closed without actually taking or giving the deliveries. Yes, you all are correct. So it is intraday, it is call option, put option, squaring the position. These are the different terms used. Correct. I hope you all understood what is speculative. Now, speculative also has exception. The definition of speculative has some exceptions. So firstly, where you are engaged in purchase sale of shares without actually taking the delivery. That is the main definition. Now it has exception where it says that a companies whose business is investing, a company whose business is investing, that is their main business, that is they keep on investing in shares of different companies, and accordingly whenever they, means they are not investing for the purpose of selling. Their business is not buying selling of shares. If that is the case, they will come in pgp. Their business is investing the shares so that they can derive the other sources income like dividend, interest, etc. And in case where they sell the shares, they will get capital gain. Why? Because buying selling shares is not their business. Now such companies are anyways in the business of buying selling shares, so for them this definition of share trading becoming speculative is not applicable. Second, a company, the principal business of which is business of trading in shares or business of banking or of granting loans. So for these companies also, the above provision does not apply, right? Next, accordingly, if these companies carry on the business of purchase and sale of shares, they would not be deemed to be carrying on speculative business, right? Now, what is important is why we are studying this here. Firstly, you will study mainly the impact of this in the chapter of set off, where if there is a loss from speculative business, which is always a very high probability, Section 73 and Section 71, 72 of this particular act deals with set off and carry forward of losses. It says that if you are incurring a loss in a speculative business, firstly, Section 28 explanation says, explanation 2 to Section 28 says that where assessee carries on speculative business, it will be deemed to be a distinct and separate business. So first you treat it as a distinct business from your regular businesses. And in case speculation has a loss, that loss cannot be adjusted from regular business income. This is what is the key point of section 71-72, that is set off chapter. So the only point what we need to understand is what is speculative business, and second is what happens to the loss of speculative business. Abhishek, what did you mention about share brokerage? You mentioned something share brokerage, Zerodha, but what do you want to say in that? Then comes section 29. What does 29 says? 29 simply says that while computing PGBP income, you have to follow the sections from 30 to 43. In other words, it is only a guiding section. It is not telling you what to include, what to exclude, what will be allowed, what will be disallowed. It simply says that while computing PGBP income, you will be following the further sections, right? Now we come to specific sections dealing with each and every expense. In this, we have majorly done all sections. Today, we'll mainly discuss 36 one, which is left out. Other than that, majorly all sections we have done in detail, right? Yes, Hardik, no worries. Whatever you have not understood, we will come to that. So balancing charge, that will come when we study the chapter of topic of depreciation relating to power units. I'll explain that. Don't worry. Now, some very simple sections 30 and 31. They deal with what? Expenses relating to building other than depreciation. This is covered in 30. And expenses relating to land, building, sorry, not the building, plant, machinery, furniture, again, excepting depreciation, is covered in 31. So both these sections says we give you deduction for your expenses, these particular expenses. And if you read these pointers, they are giving you the four conditions. It should be related to business, current year, revenue, not an offense. If you satisfy these conditions, we allow you deduction. Yes. Then comes section 32. Again, we have discussed this in detail along with a practical example. What it says, 32 deals with allowing deduction for depreciation. What it says that you will be allowed to claim depreciation, but how much, that will be decided by the workings given in the rule. First, explanation 5 says, we read even this in our notes, that claiming depreciation is compulsory. So you do not have a choice or option. You have to compulsorily avail depreciation. This is what this section says. Further, what are the conditions given for claiming depreciation? The conditions for claiming depreciation is we will allow you depreciation either for tangible or for intangible assets. What are tangible assets, intangible assets? They have given. Then asset should have been used by the assessee. So you should be actually used. Then only depreciation is allowed. If you're not using it, no depreciation. Further, if the asset is put to use for less than 180 days, then we will allow only half of the actual depreciation. So whatever depreciation is applicable, we will allow you half. Further, you can use it actively or passively. In both cases, that depreciation will be allowed. Next, the assessee must own the asset. So you should be owner. Obviously, for getting depreciation, you should be owner. Now, if you are part owner, I'll give you depreciation partly. If you are full owner, I'll give you depreciation completely. This making partly and proportionately is also given in section 38 of the Income Tax Act. So there is section 38, it does not cover any expenses as such. It simply says that wherever you are using anything partly for business and partly for other purposes, you will be allowed the benefit of deductions in proportion. Then comes power unit, right? Now power unit, if you remember, we discussed section 32 subsection 1 clause 1 deals with depreciation of power units. It says that power units has an option what, that they can compute their depreciation on SLM basis. This is what is their option. Now what is very important, please remember that whenever they are claiming depreciation on SLM, in that particular case they will not be following block method. They will be following the accounting method. What is the accounting method? We compute or we calculate asset wise. We don't do it block wise. So all the method or all the concepts given in accounts are applicable to power units if they are following the which method? They are following the SLM method, which is option. They have to exercise this method at the start of the year, start of the business in the first year. If they opt for this method, you cannot go to the block method. If they opt for the block method, you cannot come to this method. Now, SLM calculation and everything is given in Rule 5 bracket 1A, and the rate is given in Appendix 1A of this Act. Then you have the other method of block of assets. We studied this in detail. Then you have additional depreciation, which is only allowed for us new plant and machinery, and it is not allowed under the new scheme. Yes, okay. Now this point, which Hardik had raised a question. Yes, beta Hardik, you are right. Finance lease does not give depreciation benefit. Now, students, I'm going to ask you a very simple question. A question which I believe you know the answers. I will come to know, and even you come to know whether you know the answers or not. But I believe you know the answers. Okay. In accounts, we have commonly understood one simple thing, or we have commonly not maybe understood, I don't know, that is what we'll come to know today. But at least what we have done regularly in accounts is that if you have sold asset like plant machinery, building, so any asset that you are using in your business, you have sold that like plant machinery, building, etc. And if there is any profit or loss, we put that profit or loss in P&L, right? Now my question to you all is, first, I'm sure you all will agree to this. What? You all will agree to this, that sale of asset is a capital transaction. And I'm sure you all will agree to this, or maybe this can be your question, first question, that whether the profit or loss on sale of asset like building, plant, machinery is a revenue profit loss or a capital profit loss. So maybe you can answer this. If you feel it is a revenue profit loss, you can write R. If you feel it is a capital profit loss, you can write C. Okay. Expected, right, wrong, I don't know. But yes, expected answer is majorly it is a capital profit or loss. Okay. Now the main point. Please pay attention. If it is a capital profit and loss, why is it put in P&L? Because capital items do not come to P&L. Then why is the profit or loss on sale of an asset, which according to you is a capital item, why is it put in P&L? Okay. Riddhi says should not come in P&L, but beta, I'm sure till now, whatever sums you have solved right from standard 11, any profit or loss on sale of asset, we have parked it in P&L only. Second answer which I'm getting is Sania says because asset is used in business. But asset used in business does not make the sale of asset as revenue. It's still items. This is what we have been taught that P&L should cover revenue items, right? Shruti Kumari says because we bear the expense of loss because of dual entry sale of assets. But beta, then P&L is not the right account, na Kasak, to show the second effect. If it is a capital item, we have studied this rule that P&L covers only revenue. No, no, Tambeshwari. Every sale is not revenue. If the sale is of a capital asset, how it can be revenue? Yes, Pranav, because it is not a recurring item, it is a capital item. That is why I'm saying why it is in P&L. How is sale nominal, Abhishek? Apurva, you can even use loan amount for revenue expenses. So will you put loan amount in P&L? Answer is no. No, beta Vaikuntha Vasu, you do not put it in P&L appropriation. You put it in regular P&L. Hardik, but IFRS have come very recently, and we have been doing this right from the time I'm studying. Right from 1996, I have studied this. So it is not that it is because of IFRS. IFRS were not even coined anywhere in the world in 1996, and it is even before. At least I know it from 1996. How come Riddhi capital and revenue both come under P&L? How can you say that? Okay, now let me first give you the answer, then the reasoning. The answer is it is a revenue item, and hence it comes to P&L. Tameshwari, I did not get what you have written. So my first input in this is it is not a revenue item. It is not a capital item. It is a revenue item. Acha. Let me tell you, there is a possibility that there can be a capital loss on your asset, capital profit on your asset. And if that happens, let us say if a capital profit happens on your asset, even then accounting standard 10 says you should put it to balance sheet because the rule is clear in accounts. Capital item goes to balance sheet. We call it as capital reserve. And only revenue item comes to P&L. So my answer is the profit and loss you are getting on sale of asset is revenue, and hence it is coming to P&L. If there is anything which is capital, it will go to balance sheet only. This is what AS 10 also says. Now the point is, sir, how come it is revenue? That is the main point. I'll give you the answer. How come it is revenue? My answer is this. So let us take a simple case scenario. I purchase some asset at a cost of rupees 100. Till now, I have used it for 3 years. And during these 3 years, the depreciation which I have claimed as deduction is, let us say, for simplicity, rupees 30. Now, in the fourth year, I'm selling this asset. What price I'm selling? I'll come to that. But for that first, what is your WDV at the end of 3 years? It is rupees 70. Now, I have sold this asset. Option 1 for 65 rupees. Option 2 for 92 rupees, option 3 for 108 rupees. So these are various possibilities. Now, how do you calculate profit or loss in accounts? We simply subtract the WDV from the sale price of the asset. In first scenario, I am showing a loss. In the other two scenarios, I am showing a profit. What is the loss saying? I am now talking about accounts. If it is a revenue profit or loss, take it to P&L. If it is a capital profit and loss, take it to balance sheet. Now I said it is a revenue profit or loss. How? Here the loss which I am getting of 5 rupees because I sold it for 65 whereas my book value is of 70. So account says, okay, this is actually not a loss as such. It is simply that maybe in these initial 3 years, you have claimed depreciation less. That is, your depreciation, anyways, I'm sure everybody will agree that the depreciation is only a provision. It is only an estimate. We do not know what is the exact depreciation. It is just an andas that we do when we take depreciation at that maybe this difference is not the difference of loss. It is actually the difference which has arisen because you may have taken lesser depreciation. So take this balance depreciation now. And that is why they say P&L debit. Same thing income tax says, ki Baba, we also understand the same thing. Whatever depreciation you have taken earlier, 30 rupees, that may fall short because anyways it is estimate. So this balance is also allowed to you as your depreciation. And since this is the last depreciation, why? Because now the asset is sold, we call it as depreciation and it is allowed as deduction under 30:1. So accounts also does the same thing. It says, okay, debit to P&L because it is not loss arising from sale of asset. It is just difference in valuation. Same thing happens when you get a profit. Now, when you get a profit sold for 92, this 22, what you show as profit is actually not profit. It is your recovery of depreciation allowed as deduction earlier. So what is this 22? It is not profit on your asset. Baba, your asset was of 100, you sold it for 92. How can there be profit? It is appearing as a profit again. Why? Because you claim depreciation of 30. So it is now reversing that depreciation. So that 30, which you reduce in last 3 years, calling it as depreciation, out of that 30, 22 is refunded back. So if 22 is refunded back, reverse the depreciation. Reverse means what? Show it as P&L credit. So what you debited as depreciation, now you are crediting as profit on sale of asset. And income tax also same thing. We also call it as balancing charge. And it is under 41 bracket 2. Same thing happens here. You have sold the asset. You get a profit of 38. Now, how much depreciation you claimed up till now? 30. So out of 38, the 30 rupees of profit or surplus is same. It is what? Recovery of depreciation. What you debited in last 3 years, that is reversed. So what is the impact in accounts? P&L credit. What is the impact in PGP? PGP income by the name balancing charge. But you have recovered 8 rupees more. This 8 rupees in accounts also is capital reserve. Please refer AS10. I don't remember the para number, but you'll get this. And this same 8 rupees is also referred to as capital gains. So whatever profit you earn, like in the second and the third scenario, to the extent of what was allowed as deduction earlier, it is as good as you are recovering it. So reverse it. And that is why it is coming in 41. What was the logic of 41? Expenses allowed earlier, now recovered, is treated as PGP income under 41. So this is why it is 41. But amount over and above what was allowed as depreciation earlier will be your capital reserve even in accounts, and the same thing will be capital gains. I hope students, you understood this point. And that is what is given over here in your PGBP as balancing charge and terminal depreciation. And if you understand, it is the same thing what you study in accounts. The only thing is that we never questioned this in accounts, that why profit on sale of asset is coming in P&L and not in balance sheet. But here I have shown you it is also going to balance sheet. But when you recover, how much? You recover over and above 100, which is your cost. So I sold for 108. My original cost is 100. So how much I have recovered over and above my cost is always capital profit. Today. Is this understood by all? Everybody clear with the concept of this? Beta Shruti 8 in income tax law will be your income under the head capital gains. And in accounts, that 8 is shown as your capital reserve in balance sheet. Right, beta? Then all this is not required to be learned. You will be either given the blocks, or as I had shown in my sheet, for certain assets, you need to remember the general rates, like for building 10%, for plant machinery 15, for motor car 15. So if by chance rates are not given, you will take those rates. But remembering this entire table is not required. Now they have given some simple practical examples. We have already covered the different case scenarios. I request that you solve this. Yes, Hardik, actually that day I forgot. I'm sorry. I'll do it today immediately. Now, this is also, if you all remember, I had made three categories. First is where any benefit is derived. Second is tax evasion cases. And third is where you have received the asset, but it is not regarded as transfer. So all these are covered in explanation to section 43.1 and 43.6. So we have discussed all these case scenarios, but in three categories. So this is 43.6, the format of block that we follow. In that format, what you get here after adding and subtracting, adding the new assets, subtracting the assets which are sold, what balance you get over here is called as WDV. This WDV working is given in 43 bracket 6, and then you compute the depreciation. Normal depreciation is calculated on the WDV amount at the rate applicable to the block, and additional depreciation is calculated on this cost amount. And it is calculated at a fixed rate of 20%, or if it is half, 10% now, 10% next year. Fine. Now, this is again interesting. Composite income, Rule 7, Rule 8. Actually, here they have not given the breakup of the composition income. They may have given, but I don't see. So I'm taking you through the, let us recapitulate where this is given properly at the end. What is this composite income? Let me show you. See, students, now I'm sure you all will be able to answer these questions properly. Yes, maybe here and there one or two adjustments may go wrong. Otherwise, if you apply those four golden rules and the restrictions, nothing will be wrong. Now, see, this is the composite income under Rules 7 and 8 of the Income Tax Act. They have given the breakup. Now, firstly, what is the composite income? So, your business is growing and manufacturing both. Like a simple example, Tata Tea. What is Tata Tea doing? Tata Tea has its own tea estates in Assam, in Kerala. So first step that Tata Tea is doing is it is growing the tea leaves. So first part is agriculture, which is growing of the tea leaves. Then the tea leaves are plucked from there and they go to the factory. Over there, processing is done to convert it into the tea granules, what we get at our home, what we call as chai patti or tea powder. So this particular tea powder or tea granules are manufactured. Now, when Tata is preparing or Red Label or Brook Bond is preparing its P&L, it has only one sales on the credit side, that is sale of the final manufactured product. But on the debit side, it has expenses of agriculture also, and it has expenses of factory also, because it is doing both the activities combined. So this is what we call as composite income or combined income. Now, in this particular case, the law has said that, okay, prepare your P&L, you have done the entire PGBP working, you get your PGBP income. But this PGBP income is composite because some part of it is agriculture, some part of it is manufacturing, but you have got a single net profit. Why? Because P&L credit the sales value and debit the expenses of agriculture and debit the expenses of manufacturing. All have been put debit. So you get a single net profit figure. Now, this net profit you have to bifurcate, divide into agriculture portion and the manufacturing portion. Agriculture portion will be exempt because of 10(1) and the manufacturing portion will be taxable under the head business. Now, the law has given the breakup that you have to compulsorily follow this. So, what is the business? Your business is first growing the trees where you get the that rubber is made from what? Latex something. So that material you get from trees only. So you collect from that there and you bring to factory and convert it into rubber and rubber products, right? So that latex, say latex part is the manufacturing part, and you bring it into the factory, do processing, that is the manufacturing part. So latex is agriculture, later part is manufacturing, but you get combined net profit. So losses assume 65% of net profit is agricultural, 35 is business. Similarly, second is you are in the business of coffee. So actually, if you know, coffee beans are grown and then these beans are roasted, dried, and then churned to get the coffee powder. So in case of coffee, there are two rates. If mere growing and curing is the manufacturing part is done, then it is 75-25. But if more manufacturing is involved in the form of roasting, grounding, so this is like adding more flavor to that coffee by doing some more activities and process, then it is 60% is agriculture, 40 is manufacturing. Here, the 40% that is a higher share of manufacturing because you are carrying out more operations. Similarly, you are in the business of growing and manufacturing the tea granules. In that particular case, again, the ratio is 60-40. So for composite incomes, the law has provided these assumed ratios so that you compute your PGP income firstly and then apply these ratios. Sania beta, kindly mention the number if you have any questions in that. Yes, Hardik, you're right, beta. This concept of terminal and balancing charge is only applicable to power units which is following SLM method. Page 3.334. So Sania is saying page 3.334. 3.334. So what is given? Messrs. Venus engage in manufacture of pesticide, furnishes the following particulars relating to his manufacturing unit at Chennai. WDV as on this date, so it is your opening WDV. Depreciation, including additional depreciation for PY 23-24. New machinery purchase on 1/9/24. New machinery purchase on 1/12/24. Computers purchase on 3/1/25. Okay. All assets were purchased by account pay check, so no problem. Enter amount is eligible. All assets were put to use immediately. New machinery purchase on 1/12 when computer have been installed in office. Okay. Here during the year 31/3/24, a new machinery had been purchased on this date of rupees 10 lakhs. Additional depreciation besides normal has been claimed. Now, since it is put to use on 31/10, they would have claimed half depreciation. So you have to take the balance half this year of additional depreciation. Depreciation rate is 15%. The SAC has no brought forward business loss or unabsorbed depreciation. Compute the depreciation available to the SSC as per the provisions of Income Tax Act and the WDV of different blocks as on this date if he exercises the option of shifting out of the default regime. That is, he is in the new regime. The difference is if he is in the new regime, additional depreciation will be allowed. If he is in the old regime, additional depreciation is not allowed. Second, he pays tax under the default tax regime. So, okay, you have to solve it by both the methods, old scheme and the new scheme. Sai Bada, answering your question, that whenever you are following block method, which I think you are calling as diminishing balance method, in that case, you have to compulsorily follow the rates given by Appendix 1. You will not see what is the actual life of the asset. You will compulsorily the apply rate given in the Appendix 1, read with Rule 5(1). ठीक है. So, new scheme, old scheme, opening WDV plus purchase minus sale. Correct. Now, opening WDV of plant and machinery is 30 lakhs. Now, this is what I'm trying to figure out. They are saying depreciation including additional depreciation. So, if this is including additional depreciation, how much was additional depreciation last year? It would have been 10 lakhs ka 10%, that is 1 lakh. Kasek beta, if the account says that account paid check is not used, you have paid in cash, then you will not get the deduction because deduction above 10,000 is allowed only when the payment is made by account paid check, draft or approved mediums. If you have not paid that and you have paid on cash basis, what is your query? Then I will not consider that new machine in my cost and I will not get depreciation. Yes, Kiran, beta, useful life, even if given in the sum, will have no use. See, Hardik, beta, the rates of SLM are what are also given in your module. As we saw, out of that, there are 4 5 rates which are the generic rates, right? Like for building, it is always 10, plant machinery 15, computer, etc. 40, intangible assets 25. So these are some common standardized rates that you need to remember. Yes, beta, because Hardik, why they will give SLM? SLM is anyways applicable to power units. We are no need to go into that much detail. So what rates they have given is only for WDV, that is block method. Now, 2 new machines are purchased during the year of 18 lakh rupees. And I think there is no sale. Now, how much regular depreciation I'm getting? The rate of depreciation is 15%. So I will claim 15% on this. But then half out of both these assets, this asset of 8 lakhs is for half because the date of purchase and they are saying also put to use is same. So since this is put to use after 1st October, I'll take this as half. So out of this 8 lakhs is half and balance 40 lakhs. Sorry, half means 7.5, 15. Here again 8 lakhs is half and now additional depreciation not applicable here. Why not applicable? Simple reason, because in the new scheme, additional depreciation is not allowed as deduction. Now, here which machine is half? The machine of this 8 lakhs is half. However, they have mentioned something below. New machine which is purchased on 112 and computer have been installed in office. If this is installed in office, you don't get additional depreciation. So out of the 2 new machines, I will not get additional depreciation on 8 lakhs. So I'll get only depreciation additional on 10 lakhs. Now, somebody asked me, sir, why did you take 31? Because this 1 lakh is my additional depreciation of last year. Last year, I had purchased this new asset of 10 lakhs. This asset, which was purchased on 31/10, that is after 1st October. So I would have taken only half depreciation on 10 lakhs last year. Now, under the new regime, additional depreciation is not allowed as deduction. So last year, in the new regime, you would not have claimed this additional depreciation like how I'm not claiming in this year. You would have not claimed the additional depreciation last year also. So what would be the effect? The WDV given, which is obviously as per the old scheme, will be increased by the amount of depreciation that was claimed last year. And what was the additional depreciation claimed last year? 10 lakhs into 10%. Now, in this half, I will take the balance 10% of additional depreciation. So additional depreciation half, 10% we took last year, balance half we'll take in the current year. So this 10 lakhs pertains to my last year. Remember this. But we had studied that if additional depreciation is allowed half in the last year, balance half you can take in the current year. Let's see if they have given any answer to this. Okay, they have done for computer also. I did not do for computer because I thought they only want plant and machinery. Yes, Hardik, you have a question? They have not calculated the depreciation. Why they have added back this depreciation? I did not get this. WDV as on 31/3. Oh, I did not read the question correctly then. What are they saying? WDV as on 31/3. But our current year is 24/25, no? Correct. So this is right. Depreciation, including additional depreciation of last year, 4.75. What was the reason of adding it back? Acha, okay. They have taken WDV of last year, that is before claiming the depreciation. So they have deducted depreciation to find out the closing WDV of last year, which is also the opening WDV of the current year. See, so how they have interpreted. So it means they are interpreting this WDV as WDV of income tax, like what we calculate by after idless. And then they have said that since this is WDV of last year and this was the depreciation, you'll deduct that depreciation to find out the opening WDV. Okay. So how did I get this? This is 30 lakhs WDV of last year minus depreciation of last year. So this is 43.25, out of which I adjust 8. So I'm left with additional is fine. Let us see what they have done. Actually, they may have shown it separately. Again, what they have done for additional depreciation, I don't understand. Okay, first in normal depreciation, 25.25 into 15 and 10 into 15. Okay, that is fine. We have 35.25, but they have only 25.25. What is the difference? How much is WDV? WDV is 43.25. Now, if this is hmm, so we have also done this. They have just broken it up. Additional depreciation, we have computed 10 lakhs, 20%, and additional depreciation of last year, 10% is claimed in the current year. Fine. So I think our depreciation working is matching with it. There is no problem with the depreciation working. Where have they taken half? This is where they have taken half on 8 lakhs, 7.5%. Cheap. Slightly their method is a bit more elongated. Yes, Sania, I understood that later on. So, but don't worry, Hardik, you follow my method. I know that what they have solved. Even I required so much time to understand their working. That is why you follow my method. You got the answer from my method now. Don't worry. Anyways, you are getting the same answer. So follow the method which I have explained, which I believe is more easier to approach. Fine. Okay. So Sania beta, I hope you also understood. This was mainly your question. So you got the answer to your question. Now, students, one more thing which I want to explain you in this chapter, the last thing from my side is this. Even though we studied this in the last lecture, but that we did from the let us recapitulate part. So let me do it from this part. See, these are the provisions which are called as computation of income on presumptive basis. So what is presumptive basis? We have studied the detailed computation of PGBP, whereby you do add less, you do allowed, disallowed, and on that basis you compute the PGBP income. However, besides that, for some businesses, the law says we are allowing you a presumptive method of computing your income. And for these businesses, this presumptive method is a choice. That is, they may follow the income coming from this presumptive income, or they may show a higher income. However, if they show a lower income than this, then they will have to get the books audited and do their maintenance of books. Now, what is this presumptive section dealing with? The presumptive section deals with three categories of assessees. First category of assessee is those who are engaged in goods transport business. So 44A covers those assessees who are engaged in goods transport business. How do you get to know? See, the nature of businesses, business of flying, hiring, leasing of goods carriage. So their business is goods carriage, that is, they are in transportation of goods, in simple words. Then comes the second section, 44ADA. I call it as 44 ADA. ADA means style, and who has styles? Professionals have style. So it is applicable to whom? It is applicable to professions which are specified. And what are specified professions? You'll see the list over here. It is the legal field, that is lawyers, doctors, engineers, architects, chartered accountants, company secretary, interior decorators. These are all treated as specified professions. So the second category is specified professions, and the third category is others. So these two categories are specific business. Last one is goods transporter. Second one in between is professionals, but only specified professions. That is all the learning oriented professions mainly. And then all others, all other businesses. Now, this particular section is created for those assessees for whom maintaining books, getting the books audited is not possible because they are operating at a small level. So for them, this particular section was crafted. So what does this section says? In 44AD, which is the residuary section, because the other two are specific, it covers resident individuals, resident HUF, and resident partnership firms. It does not covers LLP company, etc. Because anyways, they can properly maintain books and compute their proper income. So remember, this particular section or this particular category is made for those who are in the unorganized sector, cannot maintain proper books. So for them, this section is made. Now, that is why they are limiting this section only to individuals, HF and partnership firms, and not open to others like LLP, company, etc. Similarly, second 44 ADA, it covers resident individuals and again resident partnership firms, but not LLPs. Again, why not LLPs? Because LLPs are again in a more structured format, so they can maintain books, etc. So here in professionals, they are covering individuals and partnership firms. And in the last category, it covers any assessee. So the last category is not a restrictive category. If you are a company doing goods transport, if you are an individual doing goods transport, all are covered. So I hope eligible business or not eligible business, eligible assessee is covered. Understood. Now, what is important in the first category is these people are eligible if they are engaged in eligible business. And what is eligible business? Except the first two. Plus, we are going to study more details. So they are engaged in eligible business, and most important, they are not claiming any of these special benefits given under the income tax law. Why? Because if they have to claim these additional benefits, they have to anyways maintain books and get it audited. So if they're getting it audited already, then why not getting it audited under income tax? So for these people who are claiming any of these special deductions, this benefit is not allowed. Now, this section is also not applicable to those businesses which are one, covered in specified profession, because already we have a separate section. Two, persons earning income in nature of commission brokerage. So you're an agent. Three, a person carrying on any agency business. So second and third are both relating to brokerage and agency. So these are the three persons who are not eligible for 44 AD section. Now, there is no such exclusion in 44 AD and AE. 44 AD restricts itself to resident individual, resident HF. 44 AE applies to all. Right? Now, what are the businesses to which this particular section applies? So, first category, which is residual, it is any businesses other than those which are covered in the other two sections. So, except those, all businesses can be covered here. Most important is that their turnover in the past year is up to 200 lakhs. So if the turnover is up to 200 lakhs, that is 2 crores, no problem. You can continue. No need to maintain books. No need to get them audited. We will compute your income on a presumptive basis. Further, who are covered? Business other than the business referred to in 44A, that is the last person is dropped, whose total turnover gross receipts in the previous year is up to 300 lakhs in the relevant previous year, if aggregate cash receipt in the relevant previous year is less than equal to 5% of total turnover. So where they have at least 95% of their receipts coming through bank. So for them, the limit of this section is raised to 3 crore. So for other assessees, it is 2 crore, that is 200 lakhs. For these assessees whose major receipt is through banking, for them, the limit has been raised to 300 lakhs, that is 3 crores. Similarly, for professionals, when they will come in this specified section or presumptive income clause, when their gross receipt does not exceed 50 lakhs, or again, where their major receipts are in banking channel, except up to 5% receipts are in cash, then for them also this section applies with a higher limit of 75 lakhs. And in the third case, the person who is eligible is the person who is engaged in the business of plying, leasing of goods carriage. In simple words, who is engaged in goods transport, and there is a condition who is having not more than 10 trucks. So it means your business is a small business. So if you observe the first two conditions, the basic intention is to provide the benefit of presumptive income calculation only to those businesses which are in unorganized sector. Now, if you satisfy all these conditions, then how your income would be computed? Your income would be computed straightforward. No need to do add less, no need to study the entire PGP chapter. You can keep the entire PGP chapter aside. Your income is straightforward. It is 8% of regular turnover, 6% of banking turnover. So anything coming in bank, 6%. Anything in cash, it is 8%. This is your final PGP income, no addition, no subtraction. Similarly, for professionals, the estimated income is 50%. So according to the law, a professional, whenever it is doing a profession, its expenses are very less. So let us allow them 50%. And if you are a transporter, you may have two types of trucks. First truck is called as heavy goods vehicle. If your truck is heavy goods vehicle, then the estimated income is 1,000 per ton. So if you are transporting, let us say 12 tons, it will be 12,000. If you're transporting 10 tons, it will be 10,000. But this is in a day. So this is your income in a day. And you have to multiply it by the total number of, one second, I just made one small mistake. It is not per day, it is per month. So this income that you have computed is your income per month, and then you have to multiply it by number of months. Now this is where your vehicle is a heavy vehicle. If your vehicle is not a heavy vehicle, that is, it is not a big truck, it is a small truck, then your estimated income is 7,500 per month. So the above part, it is per ton per month. So you have to multiply it by number of tons. So bigger the truck, more would be the estimated income. And in all other cases where it is a small truck, it is 7,500 per month or part. Most important, when you are computing income by this, no need to follow any PGBP provision, no need to add less or go to restrictions because all deductions are deemed to have been given full effect. So we'll presume that when you take 8%, 6%, you have complied with all the provisions. However, there is one difference. In the first two businesses, where partnerships can be one of the assessees, there is no deduction for interest and remuneration paid to partners. So for the first business, the second business, this restriction applies. What is the restriction? Whatever you have paid to your partners, we will not allow it as deduction. However, in the third business, any salary interest paid to partners is allowed as deduction. So whatever estimated income you compute, from that you can deduct the partner's interest and remuneration. This is allowed only in third. Next point is they assume that written down value of your assets is calculated by deducting depreciation. Now, why this is clarified? Because actually you are now not going to calculate any deduction. Everything is assumed to be part of 8%. However, for knowing the WDV of your assets, you will assume that every year you are doing computation under the block method and accordingly you will keep on finding out WDV of each year. Now, the only crucial requirement or the critical or the difficult point of this section is this part. Now, what is the general rule? The general rule is either you show the estimated income what we have given or you show a higher income than that. So we have asked 8%, 6%, you show 10%, we are more than happy, no problem. But if you want to show that your income is below 8 or 6%, in case of professional below 50%, in case of tour operator or truck driver below the amounts given, then you will have to maintain books and also get the books audited. Fine. Okay, not a problem. The problem is here. What is this problem? This problem is you are covered under 44 AD. Why? You are individual. Okay. Your business turnover is below 200 lakhs or the new point 300 lakhs. Yes. And you are eligible for 44 AD, that is presumptive income of 8%, 6%. Now you say, no, I want to declare a lower income. Fine. We already studied what will happen. Maintain books, get them audited. That is fine. But there is one more punishment. It means despite of you being eligible for 44 AD, you want to be out of 44 AD on choice basis. That is, you don't want to avail this presumptive income benefit. So you want to show a lower income. See, the moment you show lower income, it means you don't want the benefit of 8%, 6% section. And that is why now I'm saying, okay, now maintain books, get them audited. Two. But there is one more challenge, which is there only in the first column, that the moment you decide to get out of this section, how you get out of this section? By showing a lower income. Then you will not allow to re-enter for next 5 years. Means what? If in a particular year, you want to show a lower income or lower profit, fine. That year you will say, I will get the books audited, vagara, vagara. But for the next 5 years, you will not be allowed to take the presumptive income section benefit. So for the next 5 years also, you have to compulsorily follow regular PGP provisions, do allowed, disallowed, check all the restrictions, TDS deducted or not, amount paid or not, and then only you can compute PGP income. But in second and third, if you are want to show lower income, there is only one punishment, get books audited, that is maintain books, get them audited, that's it. There is no 5 years restrictive clause. Here, there is a restriction of 5 years for re-entry. So if in any year you want to show lower income profit, remember for next 5 years, you'll have to do the same thing. And then the last point is in advanced tax we'll study. In general, it is quarterly every year. However, for the people who are falling in the first two sections, for them, you have to pay only the last quarter installment, not the first 3 quarter installment. And for the third case assessee, he has to pay installment of all quarters. So this is the complete provision of computing your income on presumptive basis. And we have covered now everything under PGBP. Now I keep the forum open to all your queries and questions. Please put your questions. If you want, I'll unmute you. Hardik says 50% for both cash and bank. Yes, beta, there are no two rates in professional. So for professional, both are 50%. The only thing is that if your 95% or more of your receipts are through bank, then you get the higher limit of 75 lakhs in professional category. Yes, Hardik, you're right. See, 50% is not tax beta. 50% is your income. So 100 is your professional receipt. So whatever fees you have charged to different clients is 100. You are in the presumptive section. So the law says we will presume 50 is your PGBP income, not tax. So these 8%, 50%, these are giving you the PGBP income. Now this PGBP income, add other incomes, adjust losses if any, and then apply the slab rate of tax. Then you'll get to know your tax. Sanya is saying 3.255. 3.255. But what is the illustration given here? You said na some illustration is not. Please explain bad debts. But a bad debts I think is very simple, na? Bad debts simply says that whatever are the business debts, that is the debts which you have taken into account while computing PGP income. In short, it is relating to those sales which are firstly part of your PGP income. If out of those sales, some debts becomes irrecoverable or you are writing off those debts because you have no asha that you will recover those debts, then those are called as bad debts. And these bad debts will be allowed as deduction to you. This is in simple words, beta 36, one saying about bad debts. Right, beta? Sania? Baki ICDS and all, whatever they are saying, that is only the theoretical part, but practically it simply means the bad debts which are incurred by you. But I don't go, if you remember, I had already mentioned ICDS is not applicable to your syllabus. So that is why I'm not going into the technicalities of it. Even if you read, it will have the same answer. Basically, what they are saying is you have to prove that they are your business debts that have become bad. And that is where you will be allowed deduction of the bad debts. But don't go to ICDS. It is not relevant for your exams because, see, you can see the note given over here. ICDS will be discussed at final level. So basically, ICDS are not applicable to you at inter level. So here you simply remember, apply the four rules. Is it related to business, current year, revenue, not an offense? If all conditions satisfied, get deduction. Is it fine, Sania? Yes, students, I want to make an announcement before I forget. So Monday, there is a off for you for this session. So Tuesday, you will directly come for, Tuesday, the other session immediately, you will come directly for the capital gain session. There is no PGP chapter again on Monday or whatever day it is, because we have covered it today itself. So there is no lecture and we did not want to reschedule and change the timetable. So that lecture is kept as off. So you have one off lecture where I'm expecting that you all will study, right? He's saying page 270. Nitin, you can do the sums now. You have now everything in the module. So please go through them. And because now see, sums are as we discussed at the start, we solved two sums at the start. Now all these sums are similar. Only maybe you may get stuck up with one or two problems that you can always discuss and get it clarified. Illustration 12. Okay, Hardik is seeing 12. Where is 12? Ah. So Rao and Jain, a partnership firm consisting of two partners, reports a net profit of 17 lakhs before deduction of following: salary to the two working partners, depreciation on plant and machinery under 32, and interest on capital at the rate of 15%. Okay. Now see, while computing remuneration, we have to find out book profit. Book profit is what? Book profit is profit as per PGBP before remuneration. So what is your profit? Net profit is 17 lakhs. You are yet to claim depreciation. So you will deduct depreciation of 150. So 17 lakhs minus 150 is the first deduction. Second, you will deduct 12% as interest. So 12% of 5 lakhs, it will come to 60,000. So two figures you have to deduct from 70 lakhs, 150 for depreciation and 60,000 towards your interest. So total 2 lakhs 10,000 you will deduct. So it comes to 1490, right? Now this 1490 becomes your book profit. And on this book profit, now you'll apply the slabs. For first 6 lakhs, 90%. For balance, you apply 60%. That will give you your remuneration. So see, you've got 1490 as book profit. Now on this, apply slabs. What is a slab? For first 6 lakhs, you take 90%. For balance, you take 60%. How much it comes to? It comes to 10 lakhs 74,000. This is the maximum limit. Now, how much you have paid to your partners? Salary of 40,000 each per month is payable to two working partners and it is authorized. So 40,000 into 12 is 480. 480 into 2 is 960. So your actual remuneration is 960 and your limit is 1074. So Hardik, how much we will get deduction? Whichever is lower, because this 1074 is your limit, right, beta? अम्बेश्वरी बेटा, साइंटिफिक रिसर्च कंट्रीब्यूशन क्या है? जहां पे बाहर वाला कोई भी साइंटिफिक रिसर्च करता है, वो बाहर वाला कौन है? कोई भी अप्रूव्ड साइंटिफिक रिसर्च एसोसिएशन या नेशनल लेबोरेटरी या कोई भी ऐसा अप्रूव्ड साइंटिफिक रिसर्च का बॉडी, तो आप उसको जो भी पैसे कंट्रीब्यूट करोगे, इट इज अलाउड टू यू एज डिडक्शन. और वहां पे एक चीज और क्लैरिफाई की है, जब आप बाहर वाले को कंट्रीब्यूट कर रहे हो, तो आपका उस आपके बिजनेस का उस रिसर्च से कोई संबंध है, यानी इससे कोई फर्क नहीं पड़ता है, आपको फिर भी डिडक्शन मिलेगा. इवन दो वो रिसर्च, जैसे ये सब मैंने बेटा स्टार्टिंग में बताया था, आई मीन सीए प्रैक्टिस, और वो जो बाहर वाला कर रहे हो भाभा एटॉमिक रिसर्च सेंटर है या वो हमारा इसरो है, वो जो रिसर्च कर रहे हो उसका मेरे सीए प्रैक्टिस से कोई लेन देन नहीं, बट इट इज इन नेशनल इंटरेस्ट. तो दैट इज व्हाट इज अलाउड एज डिडक्शन तापेश्वर.
Sir,
यस, बोलो बेटा.
sir, like a normal business income which we get is taxable at like slab rates, using slab rates. So, sir, PGBP for 40B, like partnership firms also, we have to do with the slab rates, or
नो
there
बेटा,
is.
फॉर पार्टनरशिप देर इज अ फ्लैट रेट ऑफ 30%.
Okay, sir. Flat
Only
rate.
for, yes, individual HFs and all, there is a slab rate,
Yes, sir.
right?
So flat 30% I will take out the tax.
Yes. On the final total income of the firm, not only PGP, whatever incomes the firm has, on
Yes,
all
sir.
that total, you will find out this, right?
Okay, sir. Thank you, sir.
Yes, students, any further doubts you all have? Anything else in the PGBP chapter? No? Yes, but definitely I'll upload the notes. I'm sorry, last lecture I should have uploaded, but actually I have back-to-back sessions. In fact, after this, immediately I have a member session also. So that day also I had the similar thing. So it just skipped from my mind. So I'll definitely do it today itself, immediately after your session. Okay, students. So if all things are clear, so then let us conclude today's session. Please go through the module, solve the entire module. If there is any doubts, please connect to me in the next lecture and ask me. And please study well. This is a very interesting chapter, a beautiful chapter, though very vast. Yes, I agree, but fine. You are at CA level, but Hardik, let us keep that aside if it is okay, right? Yes. So thank you very much, students. It was really a great means the most heaviest chapter according to me is PGBP, but I never felt so in all the sessions. In fact, I enjoyed having discussions with you all. Your liveliness, despite it being an afternoon session, still you all kept the session very much active for everyone. Yes, beta, this chapter you will be even more confident the more you practice. Just do this again and again. That's it. Nothing doing beyond this. Do this again and again. I am sure now and even in your professional life, you will be finding this chapter very, very, very comfortable. Fine, students. Okay. So I think then we can conclude today's topic. I have already informed next session we are not having. So it is a break. Please use it properly. Yes, thank you, Neeru Beta. Please use it properly for practicing either this subject or any other subject. Don't waste the time. Now you have got into the habit of studying regularly daily. Maintain that habit. It is just up to May that we have to fight it out. Right? So thank you all. Let us catch up soon. Yes, sir. Session is over. Sir, you can, Kasak, you can ask me doubt immediately in the next session whenever I'll join again. Right? Or if there is any facility you can post the doubts to BOS, I'll reply to that. Fine, Kasak? Yes. Thank you all. Thank you, technical team. Good day to all.